If you're over 50 and earning more than $145,000 a year, one of the biggest changes to retirement savings law in decades takes effect in 2026, and most people have no idea it's coming. Starting January 1st, 2026, the IRS will require that all catch-up contributions made to a 401k by workers who earned more than $145,000 in the prior year go into a Roth account, not pre-tax. Roth. That's a mandatory change under Secure 2.0, the law Congress passed at the end of 2022. According to the Investment Company Institute, Americans held $7.40 trillion in 401k plans as of 2023. A large chunk of that belongs to people in exactly this income range, people who've been maxing catch-up contributions and assuming they were going pre-tax every year. That assumption is about to be wrong. By the end of this video, you'll know exactly who this rule affects, what it means for your take-home pay, and what the right move is before this kicks in. The rule change. Nobody's talking about. Let's start with the law itself, because understanding where this came from matters. Secure 2.0, formerly the Securing a Strong Retirement Act, was signed in December 2022. It made sweeping changes to retirement accounts. Most of the headlines focused on the new required minimum distribution ages and the expanded Roth IRA options. But buried inside was a provision that affects catch-up contributions specifically for high earners. The original effective date was January 1st, 2024. But employers and payroll systems weren't ready. The IRS issued Notice 2023-75 and pushed the mandate back 2 years to January 1st, 2026. That delay bought time, but it also meant millions of workers kept going pre-tax on their catch-up contributions without realizing that window was closing. Here's the legislative logic behind the rule. Congress wanted to shift high-earning older workers toward Roth contributions because Roth dollars produce future tax revenue. Pre-tax 401k money is taxed at withdrawal. Roth money is taxed upfront. By mandating Roth catch-up contributions for high earners, Congress is essentially accelerating when the government collects on that income. That's the policy motivation. It's not about your retirement security. It's about the federal revenue picture. Knowing that context doesn't change what you should do, but it does help you understand why the rule exists and why it isn't going away. Who counts as a high earner under this rule? The threshold is $145,000. But the way the IRS applies it has a 1-year lag that trips people up. Your catch-up contribution status in 2026 is determined by your FICA wages, not adjusted gross income, not total compensation, earned from the same employer in calendar year 2025. The IRS confirmed this in Notice 2024-2. So if you earned $146,000 from your employer in 2025, your 2026 catch-up contributions must go Roth. If you earned $144,000 in 2025, you can still go pre-tax in 2026. The cutoff is exact and it resets each year. A few things to flag here. The $145,000 threshold is not currently indexed for inflation under the law as written, meaning it stays at $145,000 until Congress changes it. That's important. Inflation will gradually pull more workers above that threshold every year, even workers who would have been under it a decade ago. If you're close to the line right now, it's worth projecting forward. Also, and this matters, the rule applies per employer. If you change jobs in 2025, only wages from your current employer count toward the threshold. If you worked 2 jobs and made $80,000 at each, neither employer's 2026 catch-up contributions are affected. Your total was $160,000, but no single employer sees that. The IRS confirmed this per-employer structure in the same Notice 2024-2. Your filing status and household income don't enter this calculation at all. It's purely your W-2 wages from one employer. What Roth-Only actually means for your paycheck. Here's the practical impact, and this is where most people feel the change most directly. In 2026, the standard 401k contribution limit is $23,500 for workers under 50, according to the IRS. If you're 50 or older, you can add a catch-up contribution on top of that. For most workers over 50, that catch-up amount is $7,500, bringing the total to $31,000. Under the new rule, if you earned more than $145,000 in 2025, that $7,500 catch-up piece must go into a Roth 401k. Your regular $23,500 contribution can still be pre-tax if your plan allows it. Only the catch-up portion is forced into Roth. What does that mean in dollars? Let's walk through a real example. Say you're 54, you earned $160,000 in 2025, and you plan to contribute the full $31,000 to your 401k in 2026. You direct $23,500 pre-tax. That reduces your taxable income by $23,500, but the $7,500 catch-up goes in after tax. It does not reduce your 2026 taxable income. If you're in the 22% federal bracket, that $7,500 Roth contribution costs you roughly $1,650 more in federal taxes in 2026 than it would have under the old pre-tax structure. At the 24% bracket, that gap is about $1,800. State income tax adds more on top, depending on where you live. That's a real cost in the year you contribute. But here's my take. For most workers in this income range, the Roth structure is actually better over a long horizon. That $7,500 grows tax-free. The withdrawals in retirement are tax-free. And it gives you a bucket of money in retirement that doesn't count towards Social Security taxation thresholds or Medicare IRMAA surcharges. The upfront tax hit is real, but the long-term benefit is too. The right move is to run the numbers with your actual tax bracket before assuming this hurts you. The super catch-up window for ages 60 to 63. Now here's where this gets more interesting, and where the rules split into two tracks. Secure 2.0 didn't just change where catch-up contributions go. It also created a new, higher catch-up limit for workers between the ages of 60 and 63. The IRS calls this the super catch-up, and the 2026 limit is $11,250 on top of the standard $23,500 for a total of $34,750. This is not the same $7,500 catch-up for workers 50 to 59. It's a separate, larger amount, and it only applies during that 4-year window, ages 60, 61, 62, and 63. At 64, you drop back to the standard $7,500 catch-up. Now here's the question everyone in that age range is asking. Does the Roth mandate apply to the super catch-up too? Yes. If you earned more than $145,000 in the prior year, the entire catch-up amount, whether it's $7,500 or $11,250, must go into a Roth 401k. The income threshold doesn't change based on which catch-up tier you're in. So if you're 62 in 2026 and you earned $155,000 in 2025, your total 401k contribution can be $34,750. Of that, $23,500 can be pre-tax. The $11,250 super catch-up must be Roth. That's $11,250 going in after tax. At the 22% federal bracket, that's roughly $2,475 in additional federal taxes compared to a pre-tax contribution. But that $11,250 then grows completely tax-free for the rest of your retirement. If you're in a higher bracket at contribution time and expect a lower bracket in retirement, talk to a fiduciary about whether the math shifts. The window for the super catch-up is genuinely valuable. Ages 60 through 63 are often peak earning years, and this provision gives you a chance to make a significant tax-advantaged contribution during exactly that period. Don't miss it. What most people get wrong about Roth tax timing. Here's a misconception I want to address directly because it causes real planning errors. A lot of people assume that a Roth contribution is always worse in a high-income year. The logic sounds right. You're paying taxes now when your rate is high, instead of later when you might be in a lower bracket. But that reasoning skips several important factors. First, retirement income often isn't as low as people expect. Required minimum distributions from pre-tax accounts, Social Security benefits, rental income, and part-time work can push retirees into the same bracket, or higher, than they expected. According to a 2023 Vanguard analysis of its own participant data, many retirees in the $100,000 plus income range during working years maintain similar taxable income levels in early retirement. Second, Roth accounts have no required minimum distributions during the original owner's lifetime under rules that took effect after Secure 2.0. A traditional pre-tax 401k forces you to start withdrawing at age 73. That forced income can push you into higher Medicare IRMAA surcharges, increase the taxable portion of your Social Security, and shrink the estate you leave behind. Roth accounts sidestep all of that. Third, and I research retirement strategy for a living, so I want to be direct about this. The tax diversification argument is real. Having both pre-tax and Roth buckets in retirement gives you flexibility to manage your taxable income year by year. You can pull from pre-tax when you're in a low bracket and from Roth when you're not. That optionality has real dollar value that a simple bracket comparison misses. The data is clear. For most workers earning above $145,000 who still have a decade or more of compounding ahead, being forced into Roth catch-up is not the penalty it looks like on first read. The mandatory structure is a nudge toward something that tends to work better in the long run. What to do before 2026 arrives. You still have time. Here's the right move given what we know. First, confirm whether your 401k plan even offers a Roth option. Not every employer plan does. If yours doesn't, the IRS has said employees are not required to make catch-up contributions at all if the plan lacks a Roth feature, but you won't get to make those contributions pre-tax either. That is a significant issue. If your plan doesn't have a Roth option, escalate that conversation with your HR department now. Employers have had since Secure 2.0 passed to add the feature, and many have done so specifically to stay compliant. Second, check your 2025 W-2 wages from your current employer in early 2026. If you're near the $145,000 threshold, the number on that W-2 determines your 2026 catch-up status. This is not a gray area. It's a straightforward lookup. Third, if you're between 60 and 63, treat the super catch-up as a priority. The $11,250 limit is available for a 4-year window only. The combination of a higher limit and tax-free growth makes this one of the most powerful savings levers available to late starters. Use it. And finally, run a side-by-side projection of your retirement income with and without Roth catch-up contributions factored in. A fiduciary financial advisor can model IRMAA exposure, Social Security taxation, and RMD impacts. That projection often changes the conclusion from "this hurts me" to "this actually helps." I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this video helped clarify a rule you hadn't heard about yet, hit subscribe. We cover exactly this kind of late-stage retirement planning every week with the specifics that actually matter. And there's a lot going on with the Social Security wage cap in 2025 that directly affects how late career earners can still boost their benefit before retiring. We're covering that in depth next week. You'll want to see the numbers. Is there a specific catch-up strategy, IRS rule, or retirement account question you'd like me to dig into? Drop it in the comments and I'll work it into an upcoming video. This video may contain affiliate links. I only recommend tools I use personally.